The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. And we have the Dow Jones up about 40 today. The S&P's up a bit, and the NASDAQ is up a bit. It looks to me like there's a lot of rotation going on in things that used to be the leaders. I've posted into Tiger TV today the charts for IBB, which is the biotech index, and that's decidedly breaking to the downside. It's a much weaker than the market component, and that looks much lower to me. That is really breaking quite badly. And so we're seeing let me put that back up here. I must have lost that chart. Give me 1 second to put that IBB back up, and we'll be able to take a quick look at it here, because it certainly is a chart that is worthy of your importance, or looking at it, whatever. Anyway, it looks like it's going to drop at least another 4 or 5% down here to get down to the 237 level, based on this. It's a much weaker than market stock, as you can imagine. We've gone into new high ground by quite a bit in the Dow Jones. We've not made a higher high yet in the S&P futures or the S&P cash. We haven't done that yet. We've made a 1.27 expansion on the NASDAQ, which is the stock market on steroids. But the rest of the market is, they're starting to show some distribution in here, where the small caps, particularly the IBB, and I'm also going to show the IWM, because it also is one that is very, very weak compared to the rest of the market. It's down. It took out yesterday's lows already, if you can believe that, with the rest of the market, going up. So that would tell us that this is a much weaker than market index. So both of those are looking relatively weak compared to the rest of the market. As most of you know, the market that I follow the most of any market, of course, is the New York Stock Exchange Index. And that is the one that is making a, I will see if I can keep these at a separate thing here. I'm going to put in the chart for the New York Stock Exchange Index, the NYSE, using an hourly chart, and you'll see that we have gone up and hit the 61% retracement. We took out yesterday's high by just a few cents, and then we've sold off again. The market gapped up quite a bit because of IBM, and also, I believe, Intel, not Intel, but I believe Cisco, something else besides IBM was moving really strongly to the upside, give IBM a pretty good boost to the upside today. But if you look at this New York Stock Exchange Index chart, you can see that this is a head and shoulders pattern, with the shoulder being back on the 24th of June and the high being on July 3rd, and then the right shoulder coming in today, at the 618. Now, whether that holds or not, remains to be seen, but at least, the pattern has started to form the way we thought it would. It's made a perfect Gartley here over the last 7 trading days, and what this means is that the rest of the market, the overall stock market, the New York Stock Exchange Index, which is the 2,000 stocks in the biggest 2,000, the biggest and the most volatile and active stocks on the NYSE, along with some foreign stocks. There's over 2,000 of them in this index, and they're price weighted and cap weighted, and they have so this is a real way to look at the value of what stocks are really doing, and it's a cash index. This is how they make these mutual funds base their ETFs and some of these other things off of this index, because this is the true market. It's not the S&P, just 500 stocks. It's not the NASDAQ with just NASDAQ 100 with 100 stocks. So it's the Dow Jones with only 30 stocks. And this is a really good, gauge of what's happening, with the market. And yesterday's low, when we came down to the low we had yesterday, when the S&P came down to the 1959 level, that was a perfect 61% retracement of the previous day's low. And it was still in an uptrend. We had 3 higher bottoms, so it's certainly telling you that the market was not ready to go down as yet. So we're starting to see some rotation. That's about the only thing that I can say today looking at this. We had a pattern in the Dow Jones that is it is quite it's quite amazing when you look at it from a really long-term perspective. If you'll give me a second here, I'm going to put this into, I noticed that when I'm on the air, it takes my computer longer to do things than it usually does, and I don't understand why, but that's neither here nor there. We'll try to see if we can get these charts to size up correctly to make our Professor Al's job a little bit easier here at TFNN, but I wanted to draw this pattern in on the Dow Jones and let you see what it looks like, because it's a beautiful ABCD pattern going up into this same area where we've been several times, and it's on the long-term daily. We're still in that same zone, and we need to watch this very closely, because over the next few days here, we are coming into a zone where we could be looking at a top in the Bradley model, because the Bradley model is getting close to a spot where we could be getting ready to turn down. That window started on Monday, and it goes out until the end of the week, first of next week, all the way out to the 22nd. But then after that is when we should be starting down. The actual midday is right pretty much where we are right now. But remember, this Bradley model has inverted several times. Like I said on Monday's show, we've only had 7 times in the 120-some years that we've tested this that have told us that we have inverted 4 times. That's only happened 7 times in 100 and some years, and we've already done it 3 times. So maybe this is going to be the 4th time. We've never seen a year where it inverted 5 times. That has not happened. And the sample size is pretty good. So at 120 some years, that's a pretty good thing. But I think it's really dangerous being long stocks up in this area because of the fact that we've got so many things that are, but the door has not closed yet. And believe me, when this thing falls, folks, remember what happened just back in February. We haven't had a 10% correction. I think this is the 2nd longest period in stock market history, maybe the 3rd largest period in stock market history where we haven't had a 10% correction. It's over 6 months. No, it's longer than that, because the one we had back in February was not 10%. So we're going to find out what's going to happen here. But we did have a big break from January to February. If you remember that, the Dow went from 16,500 down to 15,300, which is pretty close to 10%, but not quite. And the market has been basically straight up since that time. But we're coming into this zone now that is really very, very interesting with all these patterns, and many of them are still being formed. Like, let's just to show you today just to give you an example here in the NASDAQ. If you'll give me a second here, I wanted to show, because it's still early in the day. I mean, we haven't really done very much here with this, but we'll take a look here. You'll see that the NASDAQ has made a new high here, and I'm going to try to resize this to keep it the same size for our viewers at TFNN if I'm able to do it. But this is just an hourly chart, so we'll look at it here, and you'll see that we've gone up and made a 1.27 expansion here in the NASDAQ, but it's still very, very early. And yesterday's correction that we had, when the S&P came down to the 61% retracement, the NASDAQ could only make the 50% retracement. So it's still been the leader. But this is only 100 stocks, and that's not really, what the market is, folks. That's not what the market is. The market is that New York. It's a market of stocks, not a stock market. So you have to keep that in mind when you're looking at this. So we're just watching this today. I believe if we go below, like I said last week, if we go below 1943, which is 30 points from where we are in the S&P, which is, quite a bit. That'd be 300 points in the Dow, roughly. That would really trigger a massive sell signal because you'd be going below last week's low, and we haven't done that since Hector was a pup. That was way back in February that we did something like that. So it's just been a grinding market, up and down, up and down. And the good part is we're starting to see really good swings in the market. In other words, 150 points up, 150 points down in the Dow Jones, 15 points up, 15 points down in the S&P. That's what you really need to start to see. If we could just get the volume to perk up a little bit here, I really think you'd start to see some pretty good swings come in here to see the market move even more dramatically than we've had over the recent times. Now, the next chart that I wanted to mention to you here is the VIX index, because I was listening to Basil, because he's the master of the VIX index, and I believe his figure was around 1175 in the VIX. Yesterday's low was a perfect 61% retracement when the market sold off. And then today, with the strength in IBM and the strength in the Dow and some other NASDAQ stocks, the market went down to the 786 retracement on the VIX. But the key point is if we can keep the VIX above 1160, 1175, somewhere in that ballpark, then it's a possibility that we could be looking at a reversal here where the market might start to come down for a few days. It will come down. And folks, I can tell you this, I've been doing these charts for many, many years, over 5 decades, and I've looked at every chart of everything. And, this is no different than any other market that we've looked at. This is a bull market that is on its last legs. I don't know how much longer it can run. It's in the marathon race, but it could go higher. There's no question about it. The Bradley model could fail from here, just like it inverted, back in March. So if that happens, then it's going to go higher. But when it does come down, it's going to be a life-changing event for a lot of people, because this is a pattern that is so big, and it's not just that. It's in other markets too. You're seeing it in the German market. You're seeing it in the Nikkei. You're seeing it all across the world. And it means something big, in my opinion. Maybe it's different this time. Maybe it's time for the old cowboy to, take the saddle off the horse and go into the corral and set up on the porch and drink some Texas Kool-Aid. So I don't know. But these patterns to me look really nasty. Got the Dow still on the run, up about 50.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back, and I've been asked to take a look at IBM, and so I've put the daily chart going back over the last 3 years, and as you can see, this stock has been much weaker than the rest of the market, not counting today, of course, because we've gapped up today, and we are now trading at the 786 retracement of the April high. But I think the most important thing to look at on this chart is if you'll look at the high that we made back on February of 2013, the market was making a 3-drive to a top pattern with a perfect AB equals CD pattern up around the 215 level. Folks, this is the exact same pattern that we're looking at here in the Dow Jones. It's the same pattern. It's just 30 stocks instead of 1. Whether it works or not, remains to be seen. But this is the pattern that we're watching here. Now, when IBM was down around the 180 level, making its 61% retracement, not very many people wanted to buy it. But that's when the ABCDs were forming, and there was a small 3-drive to a bottom pattern at that point around the 179, 180 level, and here we are up around the 193, and the market looks like it wants to go up forever. But this is what you try to do when you're doing pattern recognition: is you want to buy on the dips and sell on the rallies. And then when you have these major patterns forming, like we're seeing here in IBM and the Dow, the NASDAQ and the S&P, and so many other things, you're getting ready to go down. Now, we've already formed these patterns in IBB and in Tesla And in the IWM, which is the small cap, that looks very weak. So we're starting to see some rollover, but none of that's happening yet in the Dow. And the Dow is really a very poor indicator, but that's the one that they talk about. Remember, the Dow company is owned by McGraw-Hill, and McGraw-Hill is in publishing and communications, and so you can see why the people on CNBC and on Bloomberg are always talking about the Dow, because that's what they use as the vehicle for telling what the market really is. But it's really the New York Stock Exchange Index is what the real index is. So whether this is going to be an interesting pattern here in IBM, and we're going to continue and gap up again tomorrow, remains to be seen. But we have hit the 786 retracement here in the Dow Jones, and then we will see if the rest of it is going to hold up to this level. Now I'm going to switch gears here a little bit, and I'm going to go over to the German market for just a second, because we've had we're having a big Gartley forming here in the German stock market, the DAX. It's very heavily traded. In fact, it is really a lot easier to trade than the S&P 500, and it has completed up around 10,050. It made the top, and then we dropped about 4% into the 9,600 level. And over the last 5 days, we're making a 61% retracement now, coming in to this 9880 level in the DAX. Now we're seeing the same thing happening with the FTSE and the Nikkei and some of the other indices that we watch, the Hang Seng. It's just the overall view of what the international markets look like, because none of them appear to be breaking out. They're just making retracement entries. It's just the Dow Jones and the Nasdaq that have been the big movers. Now the S&P's no slouch. There's no question about that. It's done very, very well. But the main thing is that we're looking at this DAX as being one of the third largest economies in the world, that we really need to keep an eye on that for what's happening, because if this stops it here, some reason that the market would have a down day, heaven forbid. I know our chairman Yellen would be probably instrument some way to drop interest rates again if she could, but everybody thinks the market's going to go up forever. But I'm just saying here, be very, very careful, and we are awaiting something that's going to be a big surprise to a whole lot of people, as far as I can see with these charts that I'm watching, and I've been looking at them for several weeks and months, of course, and it hasn't happened yet, but it's coming. It's just a matter of time. Just get ready for it, because when it does come, it's going to be something that is going to be very, very dramatic. It's going to be worse than 2008. I can promise you that. Okay, we still got the Dow running up about 60, the S&P up about 7.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're back, and I've posted one of the largest markets in the world. It's not as big as the Euro or some of the Forex cross rates, but the Treasury note market is huge. These are bills. The bills are from 1 week. One second. Bills are from 1 week to 1 year, and then we have notes from 2 years to 10 years, and then after 10 years becomes bonds. Anything over 10 years is a bond, but the 10-year note is the one that is used for the auto loans and mortgages and credit cards and stuff like that. I've mentioned that many times, but the thing to look at on this chart is we've been in a really strong bear market for well over 2 years when we made the butterfly pattern up around that 132 area, and that was that same pattern that we have, that we're staring at the Dow Jones and all these stock indices. It's the same pattern, and so whether that's going to be the top or not, but the pattern is certainly there. But this Treasury note has been in a very profound bear market, and this recent rally that we've had has really gone nowhere. And this is, during the time when the Fed chairman is in there talking about rates, and they're already alluding to the fact that sometime in the near future, maybe 2150 or 2097, something like that, they're going to raise rates by 1/8 of a point or something. We'll see what happens. I know they haven't dropped any credit card rates. I know it's easier to get a car now because the leasing is a lot cheaper, but credit cards are certainly still very, very expensive, and it's really difficult to get a mortgage, folks, because if you just try it sometime. My daughter just got one, and I mean she put better than 75% down on the house, and it was still difficult, and she does very well. So it's not as easy getting loans as it was back in 2008. I think that this crisis, when it comes, is going to be a money crisis. I think there's going to be a crisis of credit because it's been too cheap for too long, and what the Fed has done, it's an experiment. And my thought about this thing with the Fed is this: they started. I believe it was the third basic U.S. bank, the Federal Reserve, which was started on December 31st, 1932. Was it 1931? No, 1913. In 1913, at the what is that place? Oh dear. I can't remember the name where it is in North Carolina. Anyway, from the Jekyll Island. Anyway, when it started in 1913, that was the third time we've had a U.S. bank, a Federal Reserve Bank. And we hadn't had one for about 45 years, I believe, maybe even 50 years. Since that time, we've been 100 years doing this. If this was so good, why weren't they doing it before? My assumption is that it is an experiment, and how it's going to end, we don't know. But they put in $4 trillion into our economy, and we're starting to see, some things. I mean, employment is getting better, but they change the numbers whenever they feel like it. So we're going to see if what's going to happen here, with this. But these Treasury notes are going. It looks like interest rates have already started higher by looking at both the notes and the bonds. So keep that in mind, what we're looking here. Now, I wanted to, but since I'm not going to be on the commodity show tomorrow, I'm going to be at the Market Technicians Association meeting in Seattle, giving a talk. Last year, the flight was canceled, and I was not able to attend. So they've rescheduled me for tomorrow, so I'm not able to. I'm not able to be on the air. So I wanted to talk a little bit about the corn, because we've had believe it or not, folks, we've had a 15-cent rally in corn that's coming off of a straight down move forever. And I wanted to just bring this chart up. If I can get the data to refresh, I should be okay. And as you can see, we've been talking about this for a long, long time, and we finally have gotten a little bit of a bounce in the corn market. It's what we call a dead cat bounce, and believe me, that cat has not bounced very much, because the corn dropped more than $5,000 just in the period of the last month, and that is a huge amount. We haven't had corn prices this low in a very, 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 very long time. So the only thing that we have to wait on is, if you want to buy corn, is to wait for a buy signal, and there's none in sight. We were watching wheat the same way, and wheat has held up relatively well compared to corn, which it should have, because that's what the charts were showing what it was supposed to do. And even though it did go lower, it was certainly not nearly as bad as it was with the corn. I mean, the corn was just a absolute total disaster. Wheat was a lot less. I mean, it went down more than $1,500, whereas the corn dropped almost 5,000, and that's a huge drop. And soybeans the same way. They had a tremendous drop, to the downside, and we just broken so much support here on some of these things that it's just it's really amazing. Now, I think we really need to talk about gold, because we're having a little bit of a bounce in gold now, but I believe we're getting close to a really strong support spot, probably coming in around the first of the week would be my guess. We are going to be. This is the first time we've had a really good correction, and we actually were able to see that coming, and I believe we're going to get down to the 1280 level, which is the area that looks like it could be the spot where you could look at the long side of look at the long side of gold, because after we hit that 61% retracement down at the 1240 level, we had a really good rally that stopped up at the 1335 level per ounce, and we had a little three-drive pattern. And now what we're looking at is we're going to see if we had two really strong moving bars down on Monday and Tuesday. Today we're getting a little bit of a bounce, which we should, because it's a little bit oversold, but that just sets up another swing down to the, I believe we're going to get down to the 1282 level. However, if we get below 1248, folks, at $60 from where we are now, you can forget about the bullish side of gold for quite some time, in my opinion, because if it can't hold $12.50 per ounce, that's roughly $50 from where it is right now, it is going to look so bad on the charts that you just don't want to be involved with it. And you know, we're seeing deflationary things in all the agriculturals, with the exception of the meats, and meats have had huge corrections. I mean, we've had a big move down in cattle, and a corresponding move down in hogs, where, you know, they were very, very overbought, and they've reversed quite a bit. But the grains have been down for a long time, and they're going lower. So those are deflationary tendencies. Silver has held up, you know, about the same as gold. There's not been too much difference, and there should be a lot of support in silver around the $20 per ounce level. And so that's what it looks like. But I still think we're heading down in gold somewhere around the 1280, maybe even as low as 1265. But we should not go below 1250. If we go below 1250, the bets would be off on the gold market from the long side. If we take a look at the long-term weekly charts on gold, which I think are very, very important, you can see that we've been in a really strong downtrend since we made the top back in 2012 in August, when gold hit 1932 per ounce. We went down to 1175, and then we had a nice rally, and then we're in the midst of another rally potentially, but we have lower highs here for the last year. Since last June, when we hit 1433, the next high was 1385, and then the high we made just yesterday was 1335. And if that's the high, that tells us that if gold gets below that 1250 level, look out. I mean, it's really going to look very, very nasty on that chart, if that in fact happens that way. Now, what we also should do is we should look at the XAU, because that's the gold and silver stocks together, and we always try to keep an eye on that, and we'll pull it up, and it's selling off due to gold. I mean, the stocks have not helped it very much, but we did get up to the 786 level, and from that level it sold off. And that's what it's doing now. It's got some support coming in here, down about another couple dollars from where it is right now. But right now I'm just watching the gold. This one looks like it's got a spot to hold just a little bit lower. What's interesting about this chart is you'll see the butterfly pattern that was formed back in August of last year, and that was, you know, basically telling you that big ABCD was a major top, and now we've had three lower tops now since that time, and the most recent one being 7 days ago. Up at the 106 level, we backed off about 7% from that level, but it's still relatively bullish. It's held up really good. I mean, it came right off the bottom at 786 when it was trading at 85, and you know, over the next month it went from 85 to 105 with virtually no interruption. So we're due for a pretty good correction somewhere down into the 93 level would be my approximation on the XAU as far as looking at that. Someone's asked me to take a look at American Barrick. I haven't seen this stock in quite a while, so I'll pull it up and take a look at it. And it did have a pretty good rally off of the ABCDs. If you'll give me 1 second here. And it went up to the 61% retracement. My goodness, maybe that number really does mean something in mathematics and in stock predictions. I'm not sure, but it sure hits it quite a bit. Okay, we'll put this chart in and let you folks take a look at it. And that's amazing how these A, B, C, D markets work. The problem is they don't work all the time, and that's where the real problem lies here. So if you have any questions, it's 877-927-6648. And the ABX, to me, looks like we could pull down to about another $2 from where we are here. That would be in corresponding with what we're looking at in the gold market, too. So either one of those, would be fine to take a look at. Someone asked me to take a look at Tesla, and I'll be happy to do that. That was one of the stocks that I've been watching just because I was able to drive my first Tesla over the past several months. I happened to be down in Florida where all the rich people are, and I was at a parking lot, and the gentleman came up with a Tesla, and I commented on his car, and he said, "Would you like to drive it?" And I said, "Yeah," and so we got in the car, and he gave me a ride. And folks, I'll tell you, I would not pay $106,000 for the car. That's just my opinion. And here again, with Tesla, we have a market that is weaker than the stock market. We have gone into new high grounds, and we haven't taken out the 786 retracement in Tesla that was made back on June 30th up at the 244 level. And the market being up strong yesterday, both Tesla was down yesterday, and it's also down today. So there's selling coming into Tesla with the rest of the market being strong. So you're starting to see rotation, folks. It's not just all the stocks going up. That's not happening. It's basically these stocks are rolling over, and that's it. So we'll see. The problem with Tesla, it's not like driving a regular car, folks. You have to learn to drive this car because the braking mechanism is basically the accelerator. And so when you release the accelerator, the braking mechanism starts. It's really a lot different. And the interior is not as nice as a Jaguar or a BMW or Mercedes or a Cadillac, in my opinion, or a Lexus for sure. But it doesn't look. It's not nearly as nice on the inside as it is with that. And I can't drive a car that doesn't make a sound. I mean, that's not human. I mean, I'm back from the days when we had muscle cars, and I really miss that sound. So I have not put my order in on a Tesla for two reasons. One, I don't want to spend that kind of money for a car, and the second reason is that they don't allow them to be sold here in Arizona. You hardly ever see a Tesla. If you do, it's one that's coming from Los Angeles, and it's hard for them to get here because it only has a 250-mile radius, for driving. So it's going to be very interesting to see what happens. Okay, we got a call from Peter in Park City. Are you there, Peter?
I am, Larry. Figured I better give you a call quickly today. It's not going to be here tomorrow, and it looks like we're on the verge of the euro finally taking out that previous low.
We are at a major ABCD here. I have had several people ask me about the euro today, and it is broken below the 786, but we've completed the ABC down here. This is a very important concept here. Peter, please stay with me because we need to talk about this. This is very important because it's so big, okay?
All right.
Thank you. Stay with us.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days, unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back with Peter. Are you still here?
Yeah, I am, Larry.
Okay, we're taking a look here at the euro, and it's at very critical because we went through the 786 about 25 pips ago at 135.45. What's interesting, though, is if you'll notice that there's a very large ABCD pattern that is completed since July the 3rd. And that's very close to these lows down here at 135.05. There's an awful lot of people that appear to be wanting to get short the euro if it goes below the 135 level. So this is at a critical level here. What I would like to comment on, and then maybe this is what your question is that whether you buy it at the 786 or do you buy it when it gets down to the ABCD. Well, my suggestion here was because the market was coming down so quickly through the 786, it would be better to wait for the ABCD to form. And if you had just a little bit of patience, you would have been able to buy the euro pretty much where it is trading right now at around the 135.25, 135.26 level. And so your risk here is only about 20 pips. And here's a contract that's worth over $130,000 that you can trade for around $200. That's a good risk-reward ratio.
Yeah, no, I agree. No, and then if it does take it out on a larger scale, you're looking at 132.15, I think, in the in the futures in the September contract?
Oh, at least, and probably below 130, because this long-term chart on the euro is one of the most bearish that you can find. I mean, it really is a bearish pattern on the long term. I'll just go back and put the last few years in here, going back the last 5 or 6 years, and the folks here at TFNN can see in Tiger TV that it's had lower tops just about every year. We just completed a big ABCD pattern up at the 140 level, and it's very important here that it holds this 135 level.
Right. Yeah, that's why I figured I'd give a call to just make sure we discuss that one today, because it's just I think a matter of time, and maybe that's what ends up bringing down having the market correct. Maybe there is an issue in Europe.
I don't know if there's any correlation to that. I've looked at those correlations and I have not seen any, but the British pound is also in an area that is very, very critical too, up at this 172 level. We rallied up to 171.90 yesterday and then broke another 80 pips, and so that's about the third or fourth time that it's attempted the 172, which is the weekly retracement going back on the British pound that completes another ABCD. So, and the yen is the same way. The yen is doing the same thing. It's also up against one that is real serious spot to turn.
All righty. Well, I appreciate all your help as always, Larry. Thank you.
Well, thank you for calling in, Peter. I certainly appreciate it, and I do love the Forex markets. I spend probably 90% of my time in Forex, and the other 10% time looking at the commodities. The Forex has so many opportunities during the day, and it trades 24 hours a day, 5.5 days a week. So it's really a good thing to trade. But the standards that we look at are also really great too. That's the S&P and all the stuff, the stocks. I don't do much stock trading, of course, but I do watch the Forex and the commodities. I'm looking for a bounce here in the grains. I know I'm not going to be on tomorrow. I've mentioned this several times on the commodity hour, but the best thing to do is you wait a week or two and the pattern will form. It'll give you a very low risk entry. They're not going to turn and run straight up from here because the market has been totally demoralized, and so the first time that it rallies and then starts to sell off, the longs will remember what happened, and that's it. So live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.